Hello everyone, welcome to my YouTube channel. Today I have taken a scenario from the taxation and concept is non-deductible tax. So how to deal with non-deductible tax? And non-deductible tax meaning is that a tax is already paid to a vendor that cannot be balanced against the output tax. Meaning that you have paid the tax to the vendor, but you cannot claim it. You cannot claim from the government against the output tax. In case of non-deductible tax, the tax amount will be loaded to the material, inventory or expenses, and the company cannot claim this tax amount back from the government. So let us see general situation, generally how it happens when you pay the tax and we collect the tax, and then we'll correlate that with non-deductible tax scenario. So this is the example. So generally when you purchase anything from vendor, that time your journal entry will be like purchase account debit or expense account debit or material account debit will be debit. Then you pay tax to the vendor, and that input tax account debit will be debit and your vendor account will be credit. So this is journal entry when you purchase from the vendor. When you do the selling to the customer, journal entry will be customer account debit, revenue account credit, and your output tax account will be in credit. So this is you have collected from the customer, and this is you have paid to the vendor. So whatever you have paid to the vendor, that you can claim from the government, you can collect this amount, and whatever you collected from the customer, that you have to pay to the government. So for example, your collection is 200, but you have paid only 100. So 200 is more than your 100. So remaining 100 rupees you have to pay to the government. For example, if your pay tax is more, or your input tax is more than your output tax, then you can claim to the government. So government will refund you money. So this is what the general scenario. So separate line item comes for the tax, and for this input you will be having output also. So you can do the knockoff. But in case of non-deductible tax, you don't get separate line item for the input tax or output tax. So the tax amount get added to your purchase account or your expense account or your material account. So this is the concept of non-deductible tax. So when you don't have chance to claim from the government, or you don't have chance to collect from the customer, or you don't have any chance, either you claim input or you collect output from the customer. In that scenario, you have to use non-deductible tax scenario. So that scenario is known as a non-deductible tax scenario. So in this scenario, the tax amount, either it is input or it is output, it get added in the purchase account, if it is sales case in the revenue account. So this is called non-deductible tax scenario. Now how to map this scenario in the SAP? So I am going to talk about GST point of view, but concept remains same for all the country in terms of non-deductible tax. So for GST, SAP has given for non-deductible tax for central GST case JICN given standard condition type. Then for state GST non-deductible case, this is given JISN. So this is ND case, non-deductible case, non-deductible case, and non-deductible case. Only central GST, only state GST, only integrated GST, there is other condition type. But for non-deductible central GST, this is the condition type. For non-deductible state GST, this is the condition type. For non-deductible integrated GST, this is the condition type given by SAP. So this is the T code to see the condition type. So go to OBYZ. You can go to OBYZ, click on condition type, and you can see the standard. So these are the standard condition type given by SAP for non-deductible state GST. Similarly, there will be integrated GST. So ZICN. This is a central GST and this is the integrated GST non-deductible. I have copied this and I have converted as per my requirement. So I have made. So these are the condition type of copied and renamed it. So for central GST non-deductible, I have given TICN, and for state GST non-deductible, I have given ND, this one TICN. So I have changed accordingly. So this first step is done. Second step, to account key. In the account key, there is also difference. So this NVB is account key given by SAP for non-deductible tax. So how to view this NVB account key? T code is OBCN. To go to here, I think this is the only T code we are already open. So T code is OBCN. Come here, NVB. So this is the account key given by SAP to use for non-deductible cases. So in this should be ticked, and this is third one is very important, posting indicator. When you don't want to post to separate line item, then you have to select third one. Third one means you are distributing the expenses. It means that you are adding the tax amount also in the purchase here. You are adding this tax amount in the purchase line item. So that is the meaning of taking the 3. If you want to post like separate line item, then you have to select second case. But our scenario is this one, third case. So you have to select the third one and you have to save it. And then this configuration is also done. Now next step, we have to see the tax procedure. So to see the tax procedure, you have to go to OBYZ T code, OBYZ. So this is the tax procedure. Our tax procedure T code is ZTXIN. Select this one, come here, and as you know that this is our non-deductible 3 condition type. So this 3 condition type I have mapped with my account key. This account key is required just to calculate the tax. So this 3 account key I have mapped here. Now GL mapping is not required. Why GL mapping is not required? Because you are not posting your central GST non-deductible, state GST non-deductible, integrated GST non-deductible to any tax, any GL code you are not posting to any GL code. Therefore GL mapping is not required. So now next step, you have to go to tax code creation. So T code is FTXP to create the tax. Come in /FTXP. So give your country IN. I have created N1 tax code. So N1, in N1 tax code, I have mapped non-deductible central GST 2.5%, non-deductible state GST 2.5%. For IGST, we will create one more tax code and will map here 5% in case we need it. So N1 I have created. Let us post one journal entry and we will check how it looks. So come here, give here, text test ND scenario, give here 100 rupees or 200 rupees you can give. Select area N1 tax code, give your cost center, give your HSN, give your business place. See 200, whatever you are given 200 it is there. You have to select the calculate tax. If you select this, then tax will be calculated. So we have given 2.5%, 2.5%. That's the reason it is calculating 5% and 200 rupees. So it is coming 10 rupees as a tax. So total become 210. 210, total it became 210 rupees. So here you can check, see it is N1, it is coming properly, tax amount got calculated. But if you simulate it, you will not find separate line item. It will be added in purchase only. See, separate line item is not coming. It got added in the purchase amount only. So this is called non-deductible tax process. So save it. Thank you so much for watching this video. Please subscribe the channel. I will be covering more and more about GST scenario in incoming videos. Thank you.